Hello everybody, Luke Gromen, FFTT. Hope everyone is well on this Tuesday night. I apologize, it's been a few weeks since we've done this, and normally obviously we do it on Sunday nights, but actually the reason it's gotten pushed is an uptown problem. My son plays baseball. Up until this Sunday night, they had gone 4 straight weeks without losing on a Sunday. So we were always getting home late on Sundays, and so at any rate, we are here now, excited to be here, and let's jump right into some of the things that you guys were reaching out about. Appreciate everyone dropping questions, thoughts, and observations below the tweet. So I'm going to jump right in here. From DS, banks not lending. What are our thoughts about the banks not lending? To me, I think this is something that is, I guess the way I would answer it is they are lending. They're lending to the U.S. government, though. So if you go to the Fed's H.8 report, and this is something we talked about on the Real Vision interview or Real Vision conversation with Hugh Hendry last week. Bank holdings, U.S. bank holdings of U.S. Treasuries and agency bonds rose at a 48% annual rate in the month of June. That's 48%. And so I continue to think one of the biggest things that happened this year that is significantly underappreciated was the Fed changing the supplementary leverage ratio or SLR regulations back on April 1st to exempt treasuries from the calculation of bank leverage ratios. What this means is banks don't have to hold capital to buy treasuries. It makes it an infinite leverage trade. It means that as long as yields are nominally positive, banks can buy infinite amounts of treasuries and it doesn't count against their capital ratio. It means it allows the Fed to do infinite QE through the banking system. I think this is very underappreciated. I think it's very important that people pay attention to it. Second question, WP, implications of negative rates, if in fact that happens. In my opinion, I continue to think negative rates are unlikely. When you talk about the bid for the dollar taking place as a result of dollar-denominated debt and the need for a positive, or the need for more dollars created by the fact that there's a positive interest rate on that debt, to me, if you take it to a negative interest rate, you instantly begin swapping $12, $13 trillion in dollar-denominated debt, which is a bid for the dollar, into an offer for the dollar. In other words, you turn these liabilities, dollar liabilities that support the dollar, into dollar assets. And effectively, an oversimplified way to think about it is everybody could refinance at negative rates in theory, or close to zero. This is an oversimplification, but at negative rates, being in debt turns into an asset because the bank owes you. More practically speaking, $7 trillion plus in dollar-denominated FX reserves would likely start bidding for gold. And I think that's why they will do everything they can to not let rates go nominally negative. From SG, why do you see $5,000 gold as a positive for the world economy as opposed to others who say it'll mean fiat collapse? Is it fiat? Fiat would be collapsing against gold. I wouldn't argue that. The reason we say it's positive is it would imply that gold is being allowed to become big enough to be a neutral reserve asset. And so the dollar would be more appropriately valued versus gold. The dollar debt overhang that many say will touch off, when you think about it, many say that if the dollar rises too far, this dollar shortage, it'll touch off this dollar debt Armageddon, financial Armageddon. And that's right. We saw that earlier this year. That said, if Armageddon is if the dollar gets too strong, then it stands to reason that if the dollar weakens and makes that dollar debt more affordable to pay back, that's whatever the opposite of Armageddon is. And when you see gold going to 5,000, if it goes there, if gold is at 5,000, that would be a sign that the dollar debt overhang is being significantly reduced. And basically, we're now at a debt situation where it's either default or devalue. And it would say we're going the devalue route. I think it would be a strong signal of that. And that's ultimately the better of the two scenarios. Let's see here. It would also allow a U.S. manufacturing renaissance, by the way, as the dollar would be much more competitive. From DD, that Luke would love to know the importance in your mind of actually having physical gold coins to complement gold mining stocks as well. To me, I think it's critical to own physical gold as part of gold exposure. I think gold mining stocks are great. I think you want to be careful of your jurisdictions in which you own them to make sure you have protection, legal protections of preferably the Anglo-American judicial system, which means Canada, U.S., etc. There is a scenario where gold, physical gold, actually outperforms miners or paper gold. There are scenarios where that happens, whether that be a paper market breakdown that gets cash settled at the prior day's close, or in the case of miners, if governments say we want to take the last X thousand dollars of upside as ours and miners get to keep the first X thousand dollars, then in theory, holders of physical would capture the entire upside while holders of miners, while still very satisfied with their returns, wouldn't get as much as they think they would. These are all hypotheticals. I'm not saying they're going to happen. All I'm saying is that they could, and as a result, I think that's part of the reason why you want to own, have a good chunk of your exposure to gold via physical holdings. Let's see, HF, why banks aren't lending, your take on Jeff Snyder's Three Strikes article. I touched on earlier why we think banks aren't lending. They are to the federal government in a big, big way. And in terms of Jeff's Three Strikes article, I would say watch the signs that the Fed and Treasury have been basically married, that they are now acting in a coordinated fashion. Whether you look at the National Defense Production Act that Trump invoked in March, whether you look at the SLR regulation changes that the Fed imposed in April, whether you look at what the U.S. government did with Kodak last week, whether you look at the Lisa Murkowski bill out of Alaska last week, all of these things are pointing to a much more nationalized economic system, a much more industrial production, state industrial production, planned economy, driven by coordination between Treasury and Fed. And so I know Lacey Hunt has said the Fed can lend money, but it can't spend money. Well, Fed's lending money to Treasury. Treasury can spend money. I assure you the people in Washington, if they have one core competency above everything else, it's spending money, as we can see this year, as we can see in prior years. So if those two are married, there's no distinction between Fed and Treasury. Fed lends, Treasury spends. So let's watch that. Let's see, outlook for the long end of the yield curve and regional banks. My view is the yield curve is already in the process of or will become basically a Frankenstein yield curve, similar to what we saw during World War II, where the front end was pegged at 3/8, middle was, I think, 7/8, and then the long end was 2.5%. By fiat, and the Fed bought whatever was needed with printed money to keep that yield curve shaped in that way. It's fine for the banks. I think the positive yield curve is a positive thing for the banks, but to me it speaks to profits for the banks in nominal terms and high rates of inflation. So basically, there are probably easier ways to play that, or better ways to play that positive yield curve. Let's see, from RJ. Hi, Luke. My question would be, do you expect this equity rally to broaden out to include small caps and value stocks? Yes, eventually. It hasn't happened yet. I think it will. I think right now we'll see. Dollar weakness hasn't done it in a big way. But I mean, certainly we've had a bit of a bounce in some of the value names off the lows. But that to me is one of the $64,000 questions. It's something that hasn't played out as I would have thought. And then finally from OC, prospect on gold revaluation from both a political perspective and implications. And then the thoughts on the Bloomberg article related to the gold short squeeze. We talked a little bit about why we think physical metal may be best. So on these two, prospect of a gold revaluation where in a short period of time it gets revalued to a much higher number by authorities, I think would be done, but only in an emergency, where you'd go to bed on a Friday and you come in on a Sunday night and it would be up several $1,000s. I think that's a policy option, but I think it would be an absolute last resort. The Bloomberg article related to the short squeeze I thought was very interesting. It touched on how much more gold futures in New York are being settled physically, which is, to me, it was interesting on a number of fronts. Number one, highlighting that this has not happened very much in the past. I thought it left out two things. I thought it left out that, it brought up two things I thought were notable. The first was that some of the biggest demand is coming from other reportables, which is high net worth individuals, family offices, generally speaking, smart patient money going into physical gold and wanting the physical. Obviously, if you want physical rather than futures, the implication there is you are concerned about systemic breakdowns, you're concerned about chains of custody, et cetera. And I think that's an important thing that was left out of that. So that is the extent of the questions for today. As always, if you're interested and if you like these updates, please check out FFTT-LLC.com for more information about our different product offerings, including tree rings, which is a very popular product. 10 most interesting things we go into every week, Fridays, and we go into a little bit more detail than what you get here. So in the meantime, I want to thank everybody for joining us, and I look forward to chatting with you all soon, and have a great rest of the week, everybody. Take care.